This is a countdown to the open. I'm Alex Steele in for Jonathan Farrow. We're moments away from the start of trading. Louisville, Kentucky, apparently. That's where we're going to ring the nicey bell this morning. You had S&P futures up about 0.5%. The good news in the job market, good news in the equity market. That's holding firm. Switch up the board and let's just see where else we're trading here. So in the front end, you're seeing some strong buying in the bond market with yields kind of moving lower, and the back end kind of debating if we want to be bullish or bearish there. Dollar overall also weaker. And crude, I want to point out, the highest level that we've seen since November. Is that an economic demand story, or is that just potentially a weaker dollar story? But for now, good news is good news as the market opens on this Jobs Friday. All right, a couple stocks to watch right here at the open. You got Broadcom and Dell, the two tech companies heading in very different directions after earnings. Chipmaker Broadcom delivering a downbeat forecast, while shares of Dell are surging amid signs of rebounding demand on PCs. Bloomberg's Ed Ludlow joins us now from San Francisco with more. Ed?
Yeah, good morning, Alex. Happy Friday. Two very different directions. Let's start with Dell, the stock trading at a record high now, on track for its biggest jump since March of 2020. The story is decelerating growth. Actually, revenue fell 13% year on year to $22.9 billion, but that was still ahead of Wall Street's expectations of around $20.8 billion. EPS, $1.74 a share in the quarter gone. The Street was looking for $1.14. It's the outlook that we go to. CFO Yvonne McGill saying that revenue will be $23 billion in the current quarter, which ends in October, way ahead of expectations. And there are signs that corporate demand, at least for both their PC and data center products, bottoming out. But we go to the AI story, and they call AI a long-term tailwind. And that is something that, if you look at the sell-side notes, they are buying into this Friday morning. Broadcom, a very different story, down 3% on Broadcom shares. They're seeing pretty slow growth, the slowest top-line growth in years. But the narrative from executives is that the data center-specific chips relating to AI are gaining traction, and they're seeing demand. Broadcom does two things. It makes the chips that allow for the transfer of data between specific computers within a data center. So when AI-related function or AI clusters are being built up in a data center, they should benefit. They also make custom silicon for some of the names and the hyperscale market that are building AI-specific data center. But realistically, you go straight to the outlook for $9.27 billion in the fiscal fourth quarter. The range of estimates from Wall Street were ahead of that on the bottom end and much higher on the top end. And the question is, why is Broadcom not able to take that demand it's talking about in AI and turn it into tangible revenue growth when NVIDIA is able to? They're the same story. It's just that Broadcom's not growing, and that suggests to us that its other parts, so its other businesses, i.e. the Bluetooth Wi-Fi modem it does for Apple and other data center spending, is uneven right now.
Yeah, and it just highlights when you get that NVIDIA quarter, like just how much maybe others are struggling to monetize that. Ed, thanks a lot. Ed Ludlow joining us. We'll stay with earnings for a moment. Shares of Lululemon moving higher after the retailer raised its annual forecast. The CEO striking an optimistic tone, saying, quote, "Our continued ability to gain market share illustrates the significant runway ahead." Bloomberg's Simone Foxman has more. Simone?
Yeah, Alex, Lululemon meeting or outpacing even by a slight a bit all the metrics that Wall Street was really looking for. Comp sales up 11% year on year in North America, testament to the strength of that high-end U.S. consumer. Internationally, sales picking up as well. Sales in international markets rose 52%. Part of that was the China reopening. Part of that was store openings in China. International sales now constitute 1/5 of Lululemon's overall sales. That allowed the company to raise its expectations for revenue and profits for the year. For the full year, now sees net revenue $951 to $957 billion, or $9.51 to $9.57 billion, I should say. That's above the estimate from Wall Street that was about $9.5 billion. Maybe the reason we're not seeing a bigger move here, though, up just about 2%, is because Wall Street was already extremely bullish on the stock.
No, fair enough. Simone, thank you very much. Let's turn now to a showdown in the media space, a contract dispute between Disney and Charter Communications, leaving millions without ESPN just as the college and NFL football season kicks off. A Disney spokesperson saying, quote, "We are committed to reaching a mutually agreed upon resolution, and we urge Charter to work with us to minimize the disruption to their customers." Bloomberg's Isabel Lee has more. Isabel?
Hey, Alex. Minimize disruption indeed, and a lot of TV lovers aren't happy. So this all began because of a fee dispute. So Charter says Disney declined its proposal and pulled its video channels from Charter on August 2031. So Charter says it's currently paying about $2.2 billion in annual programming costs to Disney, but only around 25% of its video subscribers regularly engage with Disney content. So Charter is the second largest TV provider in the U.S. It has around 15 million subscribers, and this is a big deal because, as you pointed out, sports season is underway, and this affects the likes of ABC Videos and ESPN. Media companies, though, have long fought over pay TV provider for years, and this often leads to contracts and some blackout periods. For now, both shares are down. You see Disney down around 3% and Charter also down around 2%. Both parties are said to be negotiating, Alex.
All right, Isabel, thank you very much. And finally, let's go to the automakers. Tesla back at it again, implementing yet another round of price cuts for their premium vehicles in both China and the U.S., making the Model X eligible for a government EV tax credit of $7,500. Katie Greifeld has more. Katie?
Hey, Alex. Yeah, there's not too much movement in Tesla shares this morning. They're down slightly, but some pretty interesting news across the lineup. We're going to get to the price cuts, but they also revamped their Model 3 sedan for the first time since they started production 6 years ago. That Model 3 now rated to go 377 miles on a single charge in China. There's also two new colors, Stealth Gray and Ultra Red. Very fun. But probably more consequential to Tesla's bottom line are those steep price cuts to the Model S and to the Model X in both the U.S. and China. Tesla now charging just below $75,000 for the base Model S and just below $80,000 for the Model X. That is according to the U.S. website. Now, for context, those vehicles came into 2023 with starting prices of almost $105,000, $121,000 respectively. Of course, we've gotten used to this from Tesla. They've been cutting prices in both markets all year, really, in an effort to boost sales that's been coming at the expense of profit margins. And it's a big question for Tesla how they continue to ramp up sales here. You wouldn't know it by looking at the shares. In 2023, Alex, up over 100%.
Katie, do we know what color Stealth Gray is?
I don't know what Stealth Gray is. It sounds like black if you really wanted to be stealthy, but the Ultra Red is pretty cool.
No, totally cool, but you can't drive that in New York City. The Stealth Gray, I don't know, maybe. All right, Katie, thank you very much. We're just a few minutes into the trading day, the first trading day of September, because, like, when did that happen? You're looking at upside on the markets here. You got the S&P up by 0.5%. Volume finally recovering after a dismal week of volume in the markets. We're going to see how long that actually goes. Consumer discretionary, energy, information technology, materials, all on the upside within the market. Okay, so let's get a little bit more in there. Let's get into consumer discretionary. That's obviously going to be helped by Lululemon, doing pretty well. Etsy as well. All right, the 2-year yield is down by about 6 basis points, 4.80. So you're seeing the money come into the front end. The back end, though, isn't really sure what to make of this. You're seeing yields move a little bit higher here on the 10-year, 4.12%. Rick Reader, not touching the back end. BlackRock overall was saying you got to see 4.5% on the 10-year before you want to think about buying. He does like the front. He does like the belly. And the idea is that the Fed can stop raising rates. There is enough pain in certain areas of the economy in order for them to stop, and the labor market seems to be holding up. Let's get back to those labor numbers. It is a solid market here. 187,000 jobs added, a 3.8% unemployment rate. I want to welcome our Bloomberg TV and radio audiences. I'm Alex Steele, and joining us now from Washington, D.C. is Julie Su, Acting U.S. Secretary of Labor. Secretary, pleasure to speak with you. Thank you for joining.
You too.
The market sees this as a good report. Good news is good news for the market. How long can this good news continue from where you sit?
Right, that's right. That's the right characterization of this, right? This is exactly what you'd want to see if you're looking for a soft landing. This is if you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially when President Biden first came into office to the consistent, steady, stable growth that you want to see in a strong economy.
The one really big axe here, Secretary, is what's happening with the unions. You have the Hollywood strike still ongoing, the actor strike still ongoing. You have a potential auto worker strike that could hit the big three. You have trains, you have dock workers. There's a lot of union action right now. Is the White House in active conversations with these unions?
Right, so this is, we're continuing to see the effects of a tight labor market, right? We continue to have now unemployment at less than 4%. This is the longest stretch since the 1960s. And in a tight labor market, workers have more power. We've seen workers come back to the labor market and make choices about what it means to have a good job, a good family-sustaining job, a good job where they can, make demands to improve their lives and their working conditions. And the unions are a part of that. Now, you mentioned some unions where through those demands, they've resolved issues that were long-standing, that have raised wages and addressed certain conditions. You mentioned the ports. That's one area. We saw that with the Teamsters and UPS last month. We continue to see workers making these demands, and these are not just like a sort of an accident in an administration that supports working people. This is really part and parcel of workers being able to demand their fair share.
Sure, but when you take a look at the auto workers, for example, how does the administration avoid Shawn Fain as the head of the United Auto Workers overplaying his hand? The increases in demands that union is asking are tremendous. 45% wage increase, 32-hour work week, things that many say are very unrealistic. And if those workers strike, we could be looking at a recession. That's what some are saying. How does President Biden handle that?
Yeah, I mean, we have definitely seen wage increases in contracts that have been signed. We've seen them, wage increases, over 6-year periods, right, multiple-year periods. I think for a president who believes, as I do, in the collective bargaining process, we trust the process, right? We allow the parties to stay at the table. They are staying at the table. That's a good sign.
Yeah,
parties are always far apart until they're not.
But Secretary, if they stay at the table and then eventually they strike, they don't get what they want, you're looking at 150,000 plus people out of work. That is going to have a tremendous drag.
Yeah, I mean, that's right. And so that's why we remain hopeful that the parties will resolve their issues. We trust their process to do that. Obviously, strike is a part of that too. And everybody would love to see a path forward where the union and the employers do the right thing. These are, a moment in which union members are seeing historic profits coming out from, a pandemic. I think the parties have to remain talking.
So to that point, do you think that the big three are negotiating in good faith? Shawn Fain doesn't think so. Do you think so?
I'm not at the bargaining table. I'm not there. I do think that some of the, what gets said is reflective of what's happening at the bargaining table. Some of it is not, right? There's lots of things that happen during the process of a negotiation. I think it's important for us to allow the parties to do what they need to do, and that's that's what we're doing here.
I totally get it, and there is a process. But if President Biden is facing something like 3 big auto strike working, so 150,000 people maybe out of jobs plus, or a 45% increase in wages. Both of those are difficult. On the one hand, you have a recession fear. On the other hand, that's going to lead to higher inflation with wages. Which side are you going to come down on?
Well, I think overall, right, as we talked about with the jobs numbers, we are seeing really solid job growth and a solid, strong economic picture. I think it's important not to make too much of any one part of that. And again, each time there's been a contract that is about to expire, there's been a whole lot of hand-wringing over what's going to happen. I think it's premature. I think the contract is not yet expired. It's important to allow the parties to do what they want to do. But I will say, this president, one of the pillars of Bidenomics is to believe that workers, an empowered workforce is a good thing for working people. And that is something that he's been unwavering about.
So that really does feel like support the wage gains, even if it might come at the expense short-term of the economy. Is that a fair characterization?
Well, it's really about supporting the parties negotiating in good faith to grapple with hard issues and arrive at a place where, the president often says, when workers do well, employers profit, and the economy is stronger. That's what we'd like to see.
But before I let you go, and I'm saying this in jest, but I actually mean it, Taylor Swift has truly driven the economy in many ways. Just look at AMC. And I'm wondering, do you talk to Taylor Swift? Like, when she stops going on tour, are you actually going to be looking at, like, a weakening labor market and a weakening economy? I'm joking, but I'm also kind of serious.
Right. So I'll respond with, women are powering this economic recovery. You know, women are at the highest levels of, percent of women in jobs for the 5th month straight, record-breaking. And remember, during the pandemic, women were really devastated by, the lack of paid leave and the lack of care. We've seen women come back in really high numbers and get jobs, and we need to continue with that trend of making sure that women get to participate fully in the economy and the good jobs that are being created.
Yeah, I don't think Taylor Swift had a problem with that. I don't think her roadies, though, are women, but okay. Thank you very much, Secretary. Appreciate it, Julie Hsu, Acting U.S. Secretary of Labor. All right, coming up, President Biden preparing to deliver remarks following the latest payrolls report. So that conversation coming up next with iCapital's Anastasia Amoroso and PGIM's Michael Collins. This is Bloomberg. Joining me here. Hey, Anastasia, and thought on both of you guys for this. Anastasia, are we at a risk here for like a serious auto strike, and sort of how are you thinking about that? Question for both of you guys. But Anastasia, go first.
Yeah, Alex, I think you brought up some really good questions during the interview. And, the thing that really stuck out to me is, let's say we do end up averting the strike, but there is this real wage pressure that is happening in the economy still. Because with the labor market being as tight as it is, not enough workers available for some of the key industries, you definitely have the ability to, for this collective bargaining power to generate wage gains. And that poses a two-way problem. And of course, it has its benefits as well. But the problem is that this 4.3% year-over-year wage growth may actually stay around these levels if you continue to have this sticky wage pressure. So I think that's a real concern in the market. But the other thing, Alex, is I think is going to push more and more companies to look at what they can do in terms of investing in technology and investing in artificial intelligence to potentially circumvent some of the wage pressures that are building otherwise.
Yeah, although then unions won't like that either. Mike, what do you think?
Yeah, I mean, these headlines of these huge wage gains the unions are garnering are really eye-popping, Alex. But, we've actually parsed the data. Unions are only 5% of the private workforce now. And even if you take these big, headline wage gains, it's barely a rounding error in terms of impacting the overall wage gains. And you know what? Forget about Taylor Swift. I mean, this old Jersey boy is heading to the swamp of the Meadowlands today to tailgate and see the original boss, Bruce Springsteen.
Okay, well, fair enough, but come on. Taylor Swift had like a record-breaking tour. I mean, sorry, boss, but it ain't the same, Mike. He's gone. He doesn't want to talk to me anymore. Okay, well, that's fair enough. Guys, we're going to leave it there. We appreciate it. Anastasia Amoroso, Mike Collins, who doesn't want to talk to me anymore over Bruce Springsteen. All right, coming up at the market-moving events you need to be watching. That is coming up next in our Trading Diary. This is Bloomberg. minutes into the open here on this Friday. I gotta say, we're losing a little bit of steam. The S&P now up just 0.3%. The Nasdaq now flirting with negative territory as front-end yields move much lower. You still have a nice solid rally here with the Russell, but I want to point out the bond market because yields in the long end are ticking higher. The front end is still lower, but that's just by 3 basis points. So we are losing a little bit of this steam. The 30-year, I should point out right here, down by about 6 basis points. The best performing sector so far in the S&P is energy, and that's because oil continues to hit that level that we haven't seen since November of last year, but the dollar also just slipped into positive territory, so you have to wonder how long that move is really going to last. All right, let's wrap it up now with the trading diary. This is everything you need to be watching this week. So U.S. markets are closed Monday for Labor Day. Have a wonderful day off, everybody. We're also going to get factory goods and durable goods orders on Tuesday, so keep your eye out for that. Then Wednesday, lots of Fed speak from Collins and Logan, plus the Fed releases its beige book. And Thursday, we're going to hear from Harker, Williams, and Bostic, plus another round of jobless claims. Will they support this solid job market? Let's get right back to those numbers here. Non-farm payrolls coming in better than estimated, 187,000. If you were backing out the yellow truck bankruptcy and the workers, it would be even hotter. You also have the unemployment rate moving higher to 3.8%, but because the labor force participation rate also moved higher, and that is a good thing. You have hourly earnings on a year-on-year basis coming in 4.3%. Goldilocks. Market's taking it as Goldilocks. This is the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, September 1st. Here are the top market stories that we're following for you at this hour. Jobs just nail it. Labor market paints a Goldilocks picture. Traders start to price out Fed hikes. And that means good news is, good news. Stocks up, yields pop. It's on the front end in particular. The dollar pretty much stays flat. The market really buys into the soft landing scenario. Do you buy into it? And the state of manufacturing. We get the latest read on the economy with instant analysis from Tim Fiore, chair of the ISM's Manufacturing Business Survey Committee from New York. I'm Alex Steele with Danny Berger over in London. Guy Johnson is off today. Welcome to Bloomberg Markets. It's Goldilocks. Just for how long, Danny?
Yeah, that's the question. I got to say, they're even finding some reasons to maybe sell now. The 2-year coming off some of the biggest declines for the yield that we had seen right after that data.
Yeah, so a little bit of a reversal there. Speaking of the data, we've got ISM manufacturing crossing right now. Let's go to Mike McKee for the numbers. Mike?
Well, Alex, a mixed picture from ISM on the manufacturing side. Better than expected on the headline number. Comes out at 47.6. The estimate was for 47. It was 46.4 last month. The new orders index falls to 46.8 from 47.3, but production rises to 50 from 48.3. Employment, 48.5 from 44.4. That might have given people a better handle on what we were going to get in this month's jobs report, but because of the calendar, the ISM comes out unusually behind the payrolls report. Inventories, 44 from 46. Maybe there's some inventory building to come if consumers keep buying all the goods that they are buying. And prices paid rises to 48.4 from 42.6. Suggests still some contraction, but maybe at a slower pace. So overall, a kind of mixed picture on the ISM front, but I just read the numbers. Tim gives you the analysis on why that is.
Mike, you're more than that. But to Danny's point, we are seeing a move in the market. So the equity market is staying bid somewhat, but the dollar now moving higher, and you are fading a lot of that rally that you've seen in the bond market. You just have 2-year yields down by 2 basis points. Mike, thank you very much. So let's get right to it. Instant analysis with Tim Fiore. He's the chair of the ISM Manufacturing Business Survey Committee. Tim, what's going on here in these numbers?
Well, I think we're in the trough. It feels like we're in the trough. So, in the month of August, we actually beat the 3-month rolling average on the PMI. I look at this stuff from a demand and output and an input standpoint. The real story this month was on the output side. So as Mike mentioned, production was stable at 50, which means that revenues are probably stable too for the month, down a little bit from the month of May, because June and July had a bit of a recovery, but we seem to be slowly crawling back on the demand side. Customer inventories were about right. The better thing is that backlogs actually showed a movement above 40, which for the first time in about 10 months we've seen that. The big story here, like I said, was on the output side, production. Employment didn't come down to the same extent that it did in the July timeframe, but it's still easing. And the panelists' comments indicate that rather than using layoffs to get the headcount down to a lower level, there seemed to be a much bigger emphasis in August on attriting down, which is a much slower process and more in line with having output meet the demand cycle. Inputs are not an issue. Inputs are still very accommodative. And we can talk a little bit more about the inventory number in a minute.
And in terms of climbing out of the trough, if we're in the trough, given the slow speed at perhaps some of the employment changes that are happening, what will the speed be, again, of getting out of the trough if that's where we are right now?
Right, so we need supplier delivery number to stiffen up, to get above 50. Obviously, we need that new order level to get above 52. That will then start to drive demand back, and the pressure will be showing at the supplier level. One of the reasons why our number is so low is that the manufacturing inventory number is sitting at a 44, a historical low, which I've been saying now for the last 6 to 8 months that they've been managing their entire supply chain inventory very well. This is just one more indication that people are still positioning themselves for an uncertain future, but in any event, it's putting them in a great position to respond when demand starts to come back. I have no idea how long we'll be in this trough, but we've been running around 47 plus or minus for 4 to 5 months. I think we're in the trough. So given any external influences that don't impact the course, we're probably looking at a slow build out here.
Do I worry about the prices paid moving up so much?
Well, not yet. I think I would have liked to see that number down in the low 40s again for the second month, but still contracting kind of indicates that we're at nearly an equilibrium between where we were and where we want to be. I think there's a lot of arguments going on now at the factory floor level about what people should be paying for prices. The conversations have started about 2024 because everybody has started their budget season now and they're trying to figure out what their profit plan is going to be, and a lot of that has to do with what the input costs will be. So I don't see prices collapsing outside of the the commodity stuff, maybe easing a little bit, and cycling probably more likely than not. But it seems like we're at a price level now that is probably positioned for the next 6 months.
Where are you seeing construction spending the most robust? Tim, what's leading this?
Well, we're seeing more and more activity, especially in the machinery area and in the fabricated metal products area that are high feed-ins to construction. We're starting to get more comments around factory build-outs and capital investment around the infrastructure plans as well as the CHIPS Act. So it's now starting to finally show up. It took a little while, but I expect that to build with some momentum as we go into 2024.
Hey, Tim, this is a totally unfair question, so I'm totally going to ask it. The market has been taking the data as confirmation of sort of a soft landing, Goldilocks scenario, that the Fed doesn't necessarily have to do anything more, et cetera. Does the manufacturing data read that to you?
Well, I would agree with the soft landing thing. It kind of feels like this has been a soft landing. If it feels like manufacturing is in the trough. I don't see anything that's going to turn it more negative. In fact, everything kind of indicates that things will be a little bit more positive. But I can't really answer that last question for the Fed. We'll see how they take this data and what they do with it. That's a much longer term game. But it feels like we're sitting here, and we have been sitting here for quite some time, in a slow contraction, which I think in anybody's definition would be a soft landing.
Can we get back to the inventories question? Tim, what sort of comments have you seen there in this report?
Well, it continues with the overordering, which is pretty much cleared up. There's still a little bit out there, but nowhere near where it was 9 months ago. Customer inventory levels, our panelist customers, are at the too low of about right, the low end of about right, which is good. It's not great, but it's good. So, that leaves supplier inventories as well as our manufacturing inventories. 44 is a pretty strong contraction number. I mean, our manufacturing inventory number generally hangs between 48 and 52.
Yeah.
And here we are now down at 44 when there's lots of pressure on everybody's part to get revenue. So I think it just indicates that we've done a really good job, and the Fed has actually supported this by a year and a half worth of slow decline. We've been able to clean up that entire supply chain inventory to the point where our panelist companies are still contracting inventory at a time when things are really slow. You'd think it would be growing. So I think that's really positive. The only thing we don't really have visibility on is supplier inventories, but the fact that they're delivering faster would indicate that there's more inventory in the supply chain. But I don't think it's overwhelming.
Hey, Tim.
Because if it was overwhelming, they'd be pushing that inventory to their customers.
Hey, Tim, before we let you go, United Auto Workers could be striking. They're asking for a lot in an increased pay deal and labor contract. Are any of their industries or companies talking about that, worried about that, thinking about that?
A lot of companies are concerned about it. Last month we had not only the auto workers strike, but also the potential UPS Teamsters strike. The latter one got resolved successfully. I think there was some pretty significant price wages in there, but that would have impacted every sector across manufacturing and services. In the case of automotive, it will be limited to the transportation equipment and some of the supporting industries. Transportation equipment has been our strongest performer for the last year, so I'd hate to see that get knocked off the rails. But we had a lot of panelist comments concerned about the potential for a strike. It seems like both sides are fairly aggressive here. Hopefully they'll see some common bonds and get to a resolution. But most likely that's going to be a significant wage increase on the automaker side.
Yep, many folks hoping for that resolution. Tim, really appreciate your time this morning, your instant analysis. That's Tim Fiore, chair of the ISM Manufacturing Business Survey Committee. Now, coming up, we're going to get our question of the day. Do you buy the soft landing? The markets at first did, but are they pulling back? We'll be speaking with Mona Mahajan, senior investment strategist at Edward Jones, is our next guest. And as we head to break, Nouriel Roubini, the economist who predicted the 2008 financial crisis, shares his outlook for the economy with Francine Lacqua at the Ambrosetti Forum in Cernobbio, Italy.
A 10% correction is not totally unlikely if the economy starts to soften up globally, and if you have still inflation that is above essentially target, with core being still high in US, UK, Europe, central banks hiking somehow more. I would not be surprised if in the second half of the year we get a 10% correction in global equity markets.
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think the Fed should be done. I certainly think given this number, unless you got something very significant on CPI, I think they're not going in September.
You're seeing the kind of Goldilocks scenario that the Fed wants. I think it'd be really unlikely that they're going to move in at the next meeting.
I think this was the report that the market was looking for.
We're on track for a soft landing and the economy that still chugs along.
The unemployment rate finally, that stubbornly low unemployment rate finally ticking up, I think is good news, but you have to be careful, right? The labor market can be a real slippery slope.
Those were some Bloomberg TV guests earlier commenting on the jobs data. So our question of the day, and you can really wrap ISM manufacturing into this as well, do you buy the soft landing? As in, like, do you believe in it, or do you literally go buy stocks on it? Do you want to buy the front end with it? You can go lots of different directions with this question. So joining us now is Mona Mahajan, Senior Investment Strategist at Edward Jones. Do you buy the soft landing, Mona?
Yeah, thanks, Alex. And look, I think to the extent a soft landing means we avoid a technical recession, 2 negative quarters of back-to-back negative GDP growth, and instead see an economy that softens to below-trend growth, we think that scenario is likely. And in fact, I think we're in the camp of what many call this rolling recession, where some parts of the economy, and we saw it this morning in ISM, manufacturing is starting to stabilize. You know, keep in mind, ISM manufacturing still down for, I think, 10 straight months below that 50 level in contraction territory, but we're starting to see a bottoming and maybe even a tick higher. But on the other hand, you have the services economy, which has been, you know, all guns blazing thus far. But this week, we did start to see some softening in services, particularly from a jobs perspective and a wage perspective. So not only the job openings data earlier this month, the ADP private payrolls, but of course this morning we got a jobs report that you could argue was softer than expected. And of course, from a Fed perspective, probably in line with what they'd like to see happen going forward. But to answer your question, we think a period of below trend economic growth is likely, probably driven by some softening in the services economy, maybe some stabilization on the manufacturing side. But that kind of fall to a technical recession doesn't look likely as of now.
Well, one person who certainly doesn't want to buy the narrative or buy a large chunk of economically sensitive stocks off the back of a soft landing is Michael Hartnett from Bank of America. I want to read you quickly, Mona, part of his note that he had, I should say, before the report, but said August payrolls is the last piece of the Goldilocks jigsaw. He was looking for a softer report. We got that to some degree. High yield, home builders, and semis to signal a shift from soft to hard. Sell the last rate hike. In other words, Mona, he's saying that high-yield home builders and semis, those have been holding up, and in the months to come, they won't. What do you think of those pieces of the puzzle there?
Yeah, you know, I think generally what we've really seen is the market has been driven just by a very still narrow set of leadership. It's really been 3 sectors of the S&P 500 and really a large cap technology story that's driven the equity market higher. Now, what we would say is as that component did show signs of cooling in August, we did get a bit of a pullback. But more recently, what's really been driving the market is the bond side of the story. And so I think that's really where the focus has to shift now. If we do see a potential peak in Treasury yields, and keep in mind, historically, Treasury yields tend to peak 1 to 2 months ahead of a peak in the Fed rate hike or the last Fed rate hike. And so if we think that the Fed is done, we may actually be upon a period of peak Treasury yields. And in that backdrop, what we'd say more broadly is, yes, we're heading into September. We could see continued volatility. But as we look towards 2024, if we are getting inflation continuing to soften, if we're getting Treasury yields that have peaked and maybe stabilizing over time, rolling over, and if we're getting an earnings picture that has gone from flat earnings growth this year to a pickup next year, that's a pretty good backdrop for risk assets.
So where do you dip your toe in, Mona? So where do you dip your toe in that scenario?
Yeah, we'd say generally make sure that you are positioned for that broadening of market participation. We don't think those three sectors and those 7 names are going to drive the entire story going forward, particularly in a period of stable or falling yields. That's a good environment for some valuation pickup across the board. And really, when you think about where the attractive valuation lies, it does lie in areas like cyclical stocks, like small cap stocks, even parts of international, which may start to show stabilization in the next 12 to 18 months. We think those are the areas that we get a lot more opportunity and juice. And then, of course, we look at the bond portfolio. And really, you do want to be positioned for longer duration bonds ahead of any potential pivot lower from the Fed. So maybe you have a little bit of leeway to go, but we'd start thinking about that positioning as well.
Is there still really more juice to get out of long duration, Mona? Isn't there to some degree which they've priced in a fair amount of cuts down the road?
I think generally the 2-year has started to show some signs, and that's usually the part of the bond market that's most levered to the Fed. Some softening, but we're still pretty much near the highs of the last, call it 24 months or so. I think we did peak at about 5.05 or so on the 2-year. We're at 480 levels. We do think as the Fed thinks about or signals rate cuts, and probably not likely till mid or late 2024, we could get a more meaningful deceleration in the 2-year. So, if the Fed has indicated in its last set of projections about 100 basis points of rate cuts next year, another 100 basis points or so in 2025, we've only seen about 20 basis points of a sell-off thus far, probably more downside to go.
Mona, the potential for an auto worker strike, are you factoring, how are you as an investor with a longer term thesis looking at something like that? Because if you look at like a 46% increase in wages, even if it's over 4 years, and some of the contract negotiations are tremendously strict, and then the flip side, you have, 150,000 workers potentially out of work, which would really hurt the economy. How do you think about that?
Yeah, it's a good point, and it's a mixed picture there because, of course, wage gains have been really what have been fundamentally driving core inflation higher. As wage gains have increased, that's increased labor costs across a lot of services, even the travel, leisure, hospitality, auto, to your point. If wage gains are moving higher, that does keep inflation somewhat elevated and, puts a floor under how low it can go. But on the other hand, if we do see more broadly an economy that's softening beyond just the auto space, we could start to see, as we are seeing, job openings contract across sectors and layoff announcements start to increase as well. We've already seen jobless claims, which have remained pretty healthy, starting to trend a bit lower. And then, of course, the other big one is the quits rate. We are not seeing as many employees quit their jobs because they don't have as many opportunities to find new positions. So all of these are early signals that the labor market broadly is cooling, even though we are seeing, a unique situation in the auto sector in particular.
Unless Taylor Swift never stops going on tour. That's the only thing that can save us right now.
But it's
Beyonce,
true.
Taylor Swift.
Yeah. It's true. They are literally powering this economy. Hey, Mona, really wonderful to get your thoughts today. That's Mona Mahajan of Edward Jones. All right, still ahead on the show, a tale of two tech companies. Broadcom gives a downbeat forecast on sluggish demand, while things are looking up for Dell as the PC market revs up. We're going to have details for you in the startup next. This is Bloomberg.
It is 22 past 7 on the West Coast. Want to get to the startup? We cover the top tech stories from the Bay Area and beyond, which looks cloudy and rainy, by the way, just in case you needed to know, as Silicon Valley starts this morning. Now, joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, I just want to start with Broadcom. Pretty downbeat forecast. What was your biggest takeaway here from their quarter?
It's that no matter what the narrative about demand for their AI-relevant products, they're not showing up in the financials, and that's the difference between Broadcom and what we've seen with NVIDIA is the kind of starkest example. Broadcom makes two types of chips relevant to data centers. One allows for the flow of data between different computers or stacks within the server, and the other is their kind of custom silicon business that they make for data center operators who are carrying out AI function. The forecast for the current period, $9.27 billion, was below the low end of what analysts had estimated and way off from the high end. And I guess the story is this: even if their AI business is growing and there's demand and sales are growing there, the rest of their business is not growing, it's declining. And if you look at the commentary from the call, if you stripped out AI, there wouldn't have been any growth at all.
Then how does it make sense that Broadcom has that lack of growth again without AI, but Dell surprises both on PC and data centers?
That is exactly the question I asked this morning. Dell's sales actually fell 13% year on year in the quarter gone. The outlook that they gave for the current period, $23 billion for the fiscal quarter ending in October, was way above expectations. For them, the story is kind of more analogous with what we've seen with the names that are telling us that the end markets are bottoming out. Dell is a story about corporate spending. It's almost a sort of crystal ball into what the corporate spending environment looks like. Yeah. And analysts are buying into it, that AI will be a long-term tailwind for them, but things in their core business are stabilizing.
So, okay, interesting point. You got to show the money, and there's and if you're just a pure player versus a conglomerate, and also show the money. Okay, so Charter didn't show Disney the money.
They did not.
This feels like a very problematic issue if you're not going to have Disney on Charter Communications cable customers anymore.
Yeah, so Charter is the second largest cable provider in this nation. It provides television services to 14 million people. And what Disney said overnight is that they are going to block Charter customers from accessing specific linear television channels, most importantly ESPN, right ahead of the football season. I'm not a football fan, but there are millions out there who would be worried by this. And the problem is it goes to the core of the Disney story. Disney wants more value for their channels, for their product. Charter wants to improve its bottom line, and basically the root cause of what Disney justifies the block on is they're in a contractual dispute to renegotiate those terms. And since Sun Valley Disney earnings, we've talked about this, right, Alex?
Yeah.
How does Bob Iger think about the legacy TV business?
Right.
It's changing.
Yeah. Honestly, I just don't even understand how you watch sports in the U.S. The whole thing is very confusing to me. Ed, thank you very much. Bloomberg's Ed Ludlow, who, of course, will be on Bloomberg Tech coming up in around 90 minutes. All right, coming up, we continue the payrolls convo on Bloomberg.
We're about an hour into U.S. trading session. Stocks still fronting a pretty nice rally. It looked like we would roll over there for a second, but we didn't. And volume, the first time I can say this all week, is actually pretty good. Simone Foxman is joining us for more. Simone?
It's kind of surprising, right? Because aren't we all leaving for the Labor Day weekend?
Yeah, how high does volume stay? Let's get to that.
Yeah, well, we can see a positive reaction on these signs of moderation in that latest jobs report. We're looking at S&P futures about 0.5% higher. NASDAQ actually, the part of this market that's not moving up so much today, but we're watching the 10-year yield as the yield curve steepens across the curve, 4.16%. Crude higher by about closer to 2%. We're now over $85 a barrel for the first time since November. Back to that in just a second. I want to show you though, never say the tech rally is over, because info tech stocks are best part of the S&P all week. This is partly led by computing and hardware gains like Western Digital and Seagate. Also though, some of those tech names getting some love again. You look at Intel and beyond. But if we're looking at today, energy is the story, maybe on the back of that WTI news. We're looking at Devon Energy, Apache, Halliburton shares all rallying here with WTI, as I said, above, back up to those November 2022 levels. And the latest headline crossing from the Wall Street Journal that Aramco may try and take advantage here, potentially interested in issuing $50 billion worth of shares. That's according to Wall Street Journal sources. Alex.
All right, Simone, thank you very much. Really appreciate it, Simone Foxman. So let's get back to the jobs number. Hiring picking up in August, wage growth slowing, signaling a moderating labor market. Employment rate ticks higher, but for good reasons. Acting U.S. Labor Secretary Julie Su spoke to me in the last hour about the report.
This is if you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially when President Biden first came into office to the consistent, steady, stable growth that you'd want to see in a strong economy.
For more now on the jobs report, we are joined by Tiffany Wadling, PIMCO economist. Tiffany, what was your broad take on the jobs market? I was mentioning to Secretary Sue, that we have good news is finally good news, and that seems to be reflected in the market and the economy. Do you agree with that?
Yeah, I mean, I think this jobs, I mean, obviously you never want to, put too much emphasis on any one report, but overall I think the messages that came from this report were overall pretty good, both in terms of labor supply and labor demand. It looks like it's coming into better balance as Federal Reserve officials want. So we are seeing some slowing in job gains. That's become very clear. The Labor Secretary suggested that the 3-month moving average is 150K. That's down quite tremendously from this time last year. That's good news. But at the same time, you're seeing labor supply increase with the participation rate moving up, and steady gains there as well. So all of this is good news for the Fed. In terms of monetary policy, it certainly takes the pressure off the Fed to hike again in September.
And it was good news for the bond bulls until the ISM data came to ruin the party. Stronger than expected. You have things like new orders still outstripping inventories, a ratio which usually collapses ahead of a recession. What do you make of that data? Does that challenge the idea that things are starting to get softer at this point?
Well, I think you have to be a little bit careful about the ISM data. I mean, overall, it is going to be impacted by what the dollar is doing. The manufacturing sector is part of the global manufacturing sector, and you do get lagged effects when the dollar appreciates or depreciates. Obviously, saw a big appreciation of the dollar last year, and that came off this year. And I think it's giving you a little bit of a boost to the manufacturing sector. Now, keep in mind, however, though, things in China look much worse lately, and I think the downside risks there have certainly grown, and that's going to put downward pressure on the global manufacturing sector. China does tend to lead that, so I would just be a little bit careful of overly extrapolating some of the bounce in the ISM.
That's what we do. We got to make news every day, even on a Friday before Labor Day. So you mentioned pause for September. What about November now? What's your call on that?
Yeah, I mean, we think there's a lot of headwinds to the economy overall in the back half of this year. Obviously there's been a lot of discussion around student loan prepayment starts, but in addition to that, just the fact that we've seen tighter credit conditions, that also impacts the economy with a lag. Loan growth this year has been pretty stagnant. And so you are going to start to see those effects. We think they will become more clear in the back half of this year. And in that kind of environment, it's not necessarily clear that the Fed needs to hike again. Now, nevertheless, they're going to come out with another forecast or summary of economic projections in September, and it's not that, it's not clear to us that they actually take out a rate hike. But whether that's actually realized or not is less clear to us. The other big headwind for the back half of this year is the potential for the U.S. government to shut down. Yep. That'll have a temporary effect on the economy, but in the past has caused the Fed, to kind of change course a little bit.
Tiffany, can I tell you a game that I secretly miss, and I guess not so secretly anymore because I'm telling you and all of the viewers, debating what shape this recovery is, what the economy looks like. And what struck me was this report that of SNAP users, so the food subsidies for those at or below the poverty line, that 42% of them skipped meals in August, 55% ate less because they couldn't afford food. That's more than double of last year's share. Tiffany, these numbers are depressing. I mean, is the recession already here for those that are worst off among us?
Yeah, I mean, there's definitely a bifurcation within the economy right now in terms of frankly, the haves and the have-nots. So we are seeing, the lower income folks, they are certainly struggling. They don't have any of the pandemic-related savings, and the increase in credit card balances that we've seen, just from an economy-wide perspective, suggests to us that people are, taking out additional credit in order to, to try to smooth over their consumption. That's not sustainable. We also see that in the savings rate data, the data that came out earlier this week. The savings rate actually dropped, and it's at historically low levels. At some point, that's going to have to correct. And when it does, it's going to mean consumption growth, is going to decelerate. And so, although it's difficult to know exactly when the consumer pulls back, because there's a psychological element there, at some point they're going to have to, and that's going to be additional slowing for the economy.
So Tiffany, wrap in then a potential United Auto Worker strike. And I appreciate that we're gaming something out, but nonetheless, talking about lower income consumers already struggling, and then what we're going to have 150,000 potential people out of work because of a strike. How do you think about that in terms of the economy?
Yeah, I mean, so the strike has, I think many dimensions to it in terms of potential economic implications. So on the one hand, if they're able to get the wage demands that they're asking for, I mean, that just is symptomatic of the fact labor markets are tight, and people are able to bargain to get back some of the real wage gains that they lost since the pandemic. And so, ultimately, that's good for the welfare of those folks. Of course, there's going to be some volatility in the meantime as you have negotiations that are happening, and there could be some production disruptions in the auto sector. So that will be, put some upward pressure potentially on inflation, downward pressure on growth as that's happening. So, I mean, this is one, economists always have to smooth through noise. Not to say that this is noise, but this is temporary, probably going to be temporary. You got to smooth through this to try to see where the underlying momentum in the economy is.
What about higher gasoline prices? To what extent does that represent a threat to rebuilding inflation again?
Yeah, I mean, so, I think the inflation, obviously, I think the bigger picture for inflation here, energy prices will always be volatile, and certainly higher energy prices matter for consumers' disposable incomes. And so that is hurting, as we discussed. But in terms of what the Fed officials are concerned about, they want to know where the underlying trend in inflation is. We've kind of defined that in the context of the underlying trend in inflation absent any increase in the unemployment rate. And that still looks like it's maybe like 3.5%. So I think we still are seeing higher wage inflation as you suggested. And although these pandemic related effects are fading and that's putting downward pressure on inflation, you still have to be cognizant of those underlying trends and where they are versus the Federal Reserve's target. I think ultimately that's why they're in restrictive territory. And they're sort of signaling that they're going to remain in restrictive territory for a little while here.
Tiffany, I know it's still morning there, but hopefully now that we have both the ISM and the jobs number, you can go enjoy your Friday. Thank you for joining us. Thank you for starting it here. Tiffany Wilding of PIMCO. All right, coming up, Grayscale gets ready for a fee war with BlackRock and other firms known to undercut on ETF fees. We're going to take a closer look next on ETF Friday. This is Bloomberg.